And Kelly, you're gonna be able to check for questions.
Yes, they pop up on the screen.
Okay, so I should just start? Okay. Kelly usually does an introduction, but general advice when I'm not sure. Market's down 9%. And of course, the S&P earnings estimates are actually, is this pointing at the ceiling? Or that we're not, people don't even see that, it's just the microphone.
Yeah.
Right, just the microphone. Okay, even so, the market was down 9%, even though earnings estimates were up. So we do see earnings estimates going up. One of the reasons we're seeing earnings estimates go up, to give you in a nutshell, is that Biden has this economic rescue package for $1.9 billion. And the Democrats typically like to take from the rich and give to the poor. But in this case, what's happening is that, ironically, because combined with his energy policy, he's financing profits at oil companies, which is exactly what you would not expect. So when you see the earnings estimates going up, it's primarily in the oil sector where we're seeing earnings estimates go up, because the prices are coming down for growth stocks. So as we have this inflation, higher interest rates, and you have a higher discounted cash flow analysis for those companies. If you have higher discounted cash flow rate, then you get lower valuation for the growth stocks. So in November, we wrote about what we call the bifurcation. I've never seen so much bifurcation, the difference in valuations between the very high growth stocks and what I call the sub-10s. And then we had bifurcation reconciliation in February, and now we're saying bifurcation reconciliation is accelerating as we see those growth stocks coming down substantially, but some of those oil stocks continuing to do quite well. And that's bringing the PEs down to 16.6. So when you have 10-year treasuries now bumping up to 3%, you would still expect the 10-year treasury at below 5 to push a PE of 20. So the rule of thumb, Jordan, is that if your interest rates are at 10, your price earnings ratios come down to 10 times forecasted earnings like we had in 1980. But now with interest rates below 5, we should expect PEs of 20, but PEs are not at 20 because what we have is more risk. And the bigger risk, the real thing going on right now, is that this big influx of money is causing great gyrations in the economy and uncertainty about how that's going to unfold. So we have this conflict now between this fiscal policy coming out of the White House and then this monetary policy trying to counter that coming out of the Federal Reserve. So the fiscal policy is too much too late from Biden. Too much too late, too much inflation, too much stimulus, too much going on, causing the Fed to have to react to try and bring it all back down. The Fed is tapering, the Fed is raising interest rates, and that's bringing down the high value PE stocks. And the bifurcation, the separation in values, it's really the sub-10s that are extraordinary. If you go back to the dot-com bubble, you didn't have those real sold down sub-10s the way we had a sub-10 PEs. Okay, so the collision of fiscal and monetary policy is driving markets lower, and the Fed probably can't hold the economy steady right now. And the reason they won't be able to hold it steady is because of the lag. What we have here is that the 1.9 trillion stimulus will have more of a short-term effect, but when you raise interest rates, it can take a year for that to take effect. So what we'll have is an increase in uncertainty or an increase in the standard deviations. So what we have said in issues going back 10, 15 years ago is that if your range in earnings estimates is very narrow, your price earnings ratio is very high. But if you look at an auto company where the range in, Marcus, you're late, Marcus. Marcus Zemer is here. Sorry. In Ghostbusters, they had this character and he had this party with all these cardboard cutouts. Do you remember that? You remember Ghostbusters, the movie, and Rick Moranis has the party and he invites them into his house and he's got a party, he's got all the cardboard cutout characters. So I think I should have some cardboard cutout characters for people who are online today. So if you look at Procter & Gamble, the standard deviation might be 2 cents around a dollar estimate. But if you look at Ford or General Motors, your standard deviation might be 25 cents around a $1 estimate. So Procter & Gamble, with a very small standard deviation, is going to have a high PE of 20, 22, 23, and Ford's going to have a very low PE of 5 or 6 or 7. Now, you take that over many years, and unfortunately, the PEs stay low for Ford, and they stay high for Procter & Gamble because of the uncertainty. And in the long run, Ford makes the money. In the long run, Procter & Gamble makes money. And I think these standard deviations should somehow be balanced out. But the market doesn't trade like that. But right now, the standard deviations for economic outlook affect the cyclicals, and there's also uncertainty and some trade issues with what Goldman Sachs refers to as the deglobalization going on. So that's why we have a low PE right now. That's why PE has come down to 16.6. And I think it's overdone. Putin is using the N word. N stands for nuclear.
Bush would say
Nuclear, yeah. The world is looking for leadership to the United States. So in times of crisis like this, the Europeans in particular would like to see the US come and support them. And the US is looking for a stronger defense strategy. So the US is now looking more for the Republicans to lead America, and other people are looking for America to lead the world. So in times like this, in crisis, the Republicans are getting more attention in the US voting polls, and they're more likely to pick up seats in the upcoming mid-elections. So the swing is now towards Republicans and towards the United States having a global police force. And I know some people don't like to hear that, but that's the way the polls are going in the US right now, increasing the probability that the Republicans will pick up seats in this upcoming election. Steve, why don't you explain what the midterm elections are, so that because you're so good at it.
So every 2 years, the House of Representatives in its entirety is up for election. I'll get a little closer to the microphone so that I've gotten some feedback. So the entire House of Representatives is up for election in November, the first Tuesday, and a third of the Senate is up. And right now, it looks like the Republican the wild card is this Supreme Court decision that looks like they're going to throw out Roe v. Wade, which could change the whole dynamic of this election. It could galvanize the Democrats. But prior to this leak of the potential ruling from the Supreme Court, it looked like the Republicans were going to handedly take the Senate and the House of Representatives, would be a check on the Biden administration for the next 2 years. And it would, prevent the tax increases that Biden's proposing, and perhaps some more of this fiscal infrastructure spending that he's trying to push through with the Build Back Better plan, which looks dead in the water at this point. But I think it's really, I think it's up in the air with this Supreme Court leak.
Well, I think that's horrible, and I think that's
I think it could be. I think it could galvanize Democrats. Because right now, they're very disappointed with Biden in general.
it's a big issue. But I can't see it impacting the market the way Steve does. But Steve and I, we'll go back and forth on this. But I think it's a big issue, but I also think Leah Thomas is a big issue. So what I do want to say, though, is that, as we know, woke culture in American cultures has reached a point where the vocal minority is having a big influence on valuations. And Twitter now, of course, being a very woke, democratic, extreme left culture, has got to the point where, since it went public, it went nowhere. And so Musk said, enough is enough. I'm going to take it over, and we're going to have less moderation going on and more ability for the right to speak as well. So Twitter has gotten trouble from its minority woke culture. And the same thing with Disney. Is anyone following what's happening with Disney with the Don't Say Gay initiative in Florida? Well, Disney has an economic privilege zone where they control their own taxes and laws and everything. They basically carved out their own zone. And they're exempt from Florida taxes and exempt from a lot of Florida law. I don't know the details on it, but it's an exempt zone.
And they can issue their own municipal bonds, which they've done, about $1 billion Disney bonds that have been issued for this area around Orlando.
Now, for all you people online, I feel sorry for you, because there is an absolute beautiful rainbow right outside the window over there. Isn't that spectacular? Look at that. So I'll take you people online. I wish you could come in. It's a beautiful rainbow here. And we have great food delivered from Kusumi today. Really good. We've gone to the most expensive restaurants in town and had it catered. If you
Maybe
can't
that's a
see it, you
sign.
don't know.
Maybe we should say gay.
Yeah, so don't say gay. So it is not about being gay. What it is it's a law in Florida that says that children in kindergarten, grade 1, 2, and 3 should not be given sex education. And the sex education should wait until they're at least 8 years old. And so it has nothing to do with being gay. It has nothing, it just says, let the kids be kids until they're 8, and then we'll do stuff later. So some vocal minority Disney employees said that Disney should be taking a strong view on the law in Florida. And Disney said, we're not taking a view on that. It's not our business. And so now, the woke employees might be causing Disney to lose its special treatment in Florida because the governor of Florida is fighting it. So the woke employee issue has gone too far. As anyone knows, it's not Leah Thompson. Steve pointed this out. Leah Thompson was in Back to the Future. It's that girlfriend but no, Leah Thomas. Do you know who Leah Thomas is? Not a clue. Okay, so Leah Thomas 2 years ago was on the men's swimming team for Penn, and this January he is now a she.
Oh, this guy. Okay.
Yeah, this is a woman. This is a woman.
Winning all the races by 18 seconds.
So this stuff has just gone too far. Is the point. So go look up a picture of Leah Thomas, and she is my friend Joe. His friend was working in the coaching team at Penn's women, and a bunch of the women have just quit. They said no, because he identified. Oh, I'm gonna stop it after saying this one thing because it just gets too hot. But he walks around in the women's locker room with his male appendage out and says, "I'm a woman." It's like, no wonder women are quitting the team, right? Okay, so we're buying Activision Blizzard. Okay, so
Everybody get change.
well, I was joking around at the lacrosse club last night. I said, if I'm a cross-dressing lesbian, can I shower with the girls? I identify for the next hour. No, I shouldn't. Okay, I'm going to stop there. Okay, Activision Blizzard. We know what. So, do you want to give we'll go into it in more detail, but would you like to explain what Activision Blizzard situation is very briefly, Chris?
Yes, very briefly, it's a unique investment thesis. It's not so much a market exposure, it's a merger arbitrage or workout. It's trading at about a 21% discount to an all-cash takeout offer from Microsoft, expected to close within 14 months.
Yeah, and as we said in prior editions, Lena Khan became head of the Federal Trade Commission. And this woman did a brilliant paper while at Yale on Amazon being a monopoly. And so with the support of the Democrats and the support of Elizabeth Warren, she's this young lady, she's only 34 or something. We wrote a whole RV on her, has really changed the power structure against the big techs and against Amazon. And so this stock is being threatened with a lawsuit from the Federal Trade Commission to block this deal, but it just doesn't fit because, and we'll go into why this deal will go through. Okay, so it's not in the Amazon, it's not in the Google, it's not in the Facebook, it's not in those categories, and this deal will go through. Biggest movers in the market, Danone, they're the biggest maker of milk-based products, so yogurt and et cetera. And they also have supplemental nutritional stuff for babies, like Bed Bath & Beyond, Kimberly Park. You see the stocks that are up here are the sub-10s. Western Digital is actually a sub-10. So the sub-10 stocks are the ones that are going up, not Glaxo so much, but Leonardo, Shure, and Sherwin-Williams. So it's the sub-10 PE stocks that are going up, and it's the growth stocks that are coming down. So Netflix, we said in February, after Pershing Square took a position in it, and it had fallen 50%. We said stay away. Now it's down another 50%. And what's going on here is that there was a bump up in demand for anything online. So Netflix and Zoom and all these things, there's a bump up. And then there were projections or extrapolations that growth would continue from a new bumped up level and continue. But it now is seen as a pull forward, and we're seeing a drop off in demand, and people are going out. And they're not staying home and logging in so much. But Shopify, Spotify, Nvidia, very expensive stock, over $1 trillion. So Etsy, just briefly, the difference between Etsy and Shopify, okay? And I wouldn't expect our audience to really be involved in this end of the business, but Shopify will give you a website ready-made where you can process charges and sell things on a website. And so it is a shopping mall where they give you the whole, the whole storefront. Okay. Whereas Etsy is very different. Etsy, you are doing, you're not opening a store, you're selling a product. So you do product placement against other people who are also selling, wigs. And so you want to place it next to all these other ones, and you want to sell it at a discount. And so it's instead of opening a store, it's selling a product, but they're very different models, but they're both got a lot of traction during the pandemic and lockdowns, and they're both taking a hit now, as is Shopify and Spotify. Block, we know what Block is, right? Block bought Afterpay in Australia. It used to be called Square, the little square thing. So doing very well, but getting knocked back. PayPal, Amazon, Moderna is still a growth stock. Paramount fell with the Netflix news. Boeing, we had a week, so we've had a couple of weak stocks in here. Overall, we about matched the market, but we had 3 weak stocks. And Intuitive Surgical, another big growth stock, and Take-Two, another gaming stock, down. So most of the stocks on the downside are, this is what we call bifurcation, reconciliation, acceleration. Okay, so the bifurcation, yes, Mike?
I'm surprised that PayPal has dropped along with all the others because it deals with transactions. It doesn't sell things. It helps finance part of the payment chain.
Yes, and Visa and MasterCard dominate most of that, and Bitcoin's at the opposite end, trying to replicate everything. And Square emerges with their point of sale payment system. But the main issue at PayPal is, even though they're growing, they've been kicked out of eBay, where they came from originally, and that's causing them to lose some business share. Right?
So they are no longer a payment option on the eBay platform. That happened faster than PayPal had anticipated. And so their growth slowed. They've had 2 quarters of disappointing earnings results. And after this most recent result, a lot of investors and analysts just threw in the towel. They've reset guidance to a lot more conservative growth outlook. Before this last result, they were projecting 400 million active users, or rather 750 million active users by 2025. And they've reduced that down to 400. So that has been a negative for the share price, and it's just been pulled back with the rest of the market.
It's still a high price to sales, high price earnings ratio, high margin, high growth stock that's losing some of its excessive creamy growth. Yeah. So it could be a buy, and it went through our screen list. We thought about Intuitive Surgical, we thought about Square, we thought about PayPal, we thought about a lot of these companies, but we went with Activision Blizzard because it isn't a high beta, it isn't a high standard deviation stock. It's a binomial output of whether this deal goes ahead or not. So it's a different kind of play, and we think we can make 25% a year or 22% a year. So we'll see here that the earnings estimates are up 13% for oil stocks. And that's because, ironically, the rescue package is funneling money combined with the energy package into the price of petrol at the pump for U.S. consumers. So the consumer is getting their $1,400 checks and spending it on petrol for their cars. So the beneficiary is oil companies, because there's also a pass-through because there's tight capacity utilization in plastics right now. So plastics and paints, and they're selling that stuff to Procter & Gamble, because Procter & Gamble mixes this stuff in vats and puts it into plastic containers and sells it, right? So a lot of that cost is transportation, but a lot of it is based in chemicals and raw materials, and that's getting passed on. So we're seeing chemicals and at the pump through the whole supply chain, and oil is doing very well. And the stocks that are going up, paper and forest products, because there's extremely tight capacity utilization and unique things going on in there. But food stocks and consumer product stocks are up. Well, you can see the FANG stocks, the semiconductors, the software are all down, the telecommunications and the computers. So the real weakness in the market is this growth part of the market, where we actually have some earnings reductions in that part of the market. But the big increases in earnings estimates for oil have more than compensated for the reductions in the growth stocks. So let me try and pick up the pace a little bit here. We refer to the rescue plan as the pig and the python. So the pig and the python was a term coined for baby boomers being a big group of people moving through the US economy. And I've adapted that to say that this $1.9 trillion rescue plan is a big chunk of money going through the US economy. And that's causing inflation, and it will end. So US government debt is now up to $30 trillion. I saved and saved and saved until I was 40, and I bought a house with no debt. I've never had a little bit of student loan debt, but I'm always been a no debt. I lived on a shoestring until I was 40, and then finally I started to be able to afford things. But I've always been very, very conservative on debt. And so I particularly hate this 30 trillion. I think this 30 trillion is just horrible. And the US government, why is the US government in debt at all? Why shouldn't they run a balanced budget? I don't understand it. And the GDP is about 23 trillion. So your debt to GDP is now about 130%. Okay, so but in 1980, when I graduated from high school, it was 35%. Then in 2000, it went to 60, and now we're at 130%. So the GDP as a percentage of debt has gone up, but interest rates have come down. So remember when, well, you may not remember, but when I was graduating from high school, we had Jimmy Carter coming out, Ronald Reagan coming in, and we had Volcker coming in saying we're going to control all this inflation. But during Jimmy Carter, we had the oil embargoes and we had inflation up at 10%. The 10-year treasury was 11.5%. So with the 10-year treasury at 11.5%, with those very high interest rates, we had very low PEs. PEs were 10. Okay, and then by 2000, the interest rates come down to 6% on the 10-year treasury, and then they go down to 0. So from a time when the debt has gone from 35 to 60 to 130, interest rates have gone down from 11.5 to 6 to 0. And so there is some justification for having having 30 trillion in debt if you're not paying any interest on it. The problem is now that interest rates are going up. And so it could bite the US very badly, because if interest rates go back up to 5, they're at 3 now, if they go back to 5, the cost of servicing the debt becomes very, very difficult. And the US can't run a budget in the first place because of, well, I'll let Steve explain that the budget deficit is a problem because Social Security, because people working today pay for people who are retired, right?
Yeah.
And that's the pig in the python problem for Social Security, right? Medicare, Medicaid.
Yeah, about 60% of, or 65% of government expenditures are transfer payments in the form of Medicare and Social Security and welfare. And so, yeah, that's a major expenditure that is an entitlement and is politically unpopular change. So that is problematic. However, tax receipts are the highest they have ever been, 4.4 trillion in the last tax year, which I think speaks to the positive aspects of the Trump tax cuts. So the highest corporate tax rates we've ever had, biggest tax receipts we've ever had, and taxes are the lowest they've been.
Well, what
Tax rates, I should say.
yeah, Mike?
So where does the US government borrow the money?
China, so that's a good question. Yes. Okay. Where do they get it from?
Doesn't it borrow from the Federal Reserve as well?
No, they borrow it mostly from OPEC and China and Japan, right? So it's a really good question. What's been going on? Well, let's take this month and call it a year. The U.S. has been running a trade deficit of 50 billion a month. That's $500 billion a year. So that means the U.S. is exporting $500 billion US dollars. And that means that OPEC countries in China have $500 billion that have to be invested. And when that money gets invested, it gets invested into treasuries. So treasuries and ETFs, because China can't own ConocoPhillips, right? They gotta buy an ETF. They can't buy a company where they have any power or control. They gotta have an ETF where BlackRock can just slice stuff up for them. So they buy treasuries and ETFs, and it inflates U.S. asset values. So what's happened with the Biden to 1.2, 1.9 trillion is that trade deficit goes boom. China has all this money, OPEC has all this money, and they have to come back and buy treasuries and ETFs. So it inflates U.S. asset values. But in effect, the net is that it's kind of like an interest-free loan to the U.S. government. So a $130 billion trade deficit is an interest-free loan to the U.S. government, and it's heroin. It's just heroin. I mean, they just keep digging themselves deeper and deeper and deeper into this hole, and it's not good. I don't like debt. What?
Just a question up there.
Wants to know. Closer to microphone. Okay, Steve.
I keep getting this feedback.
What did you say?
So Biden's policy has caused a shock. How can I get rid of this?
It's like mouse, I think.
The X button on the top right side. Yes, yeah.
Closer to the mic. Okay, Steve. So the rescue plan is too much too late. 1.9 trillion caused inflation. It's a jolt to the system. It kicked supply chains, and we're left with long-term costs. And ironically, Biden is financing oil. I don't mean to sound too negative today. I know this is coming across as pretty negative, but ironically, Biden has financed oil companies or given profits to oil companies. The PPI 11% raw materials and energy seem to have peaked. Last month we put in this SunSers link where we could see the prices for a lot of different commodities. Good website to look through. Everything seems to have peaked. Capacity utilization rates for the producer side is 78% below the inflationary levels. Once you get above 80%, it gets inflationary. So when we're looking at textiles and communications at 65%, they're not making any money in textiles or communications equipment. So, somebody like Huawei is not going to make money selling stuff, but the high capacity computers, semiconductors, plastic, paper, wood, furniture. Plastic and paper is more of a political issue in the South, like in Georgia, with the policies of growing trees and cutting them down. The jolt is satisfied by buying stuff from overseas because they can't make it fast enough. So you got to buy it from Japan. You got to import stuff. So the trade deficit explodes to 125. That's just outrageous. 125 billion trade deficit is bad. So CPI less high, but we've got higher wages. And so with unemployment going to 3.6, we have people, you can't hire people. So companies like Hospital Corporate America, HCA, they got to pay nurses a lot more money. And so their profits missed and they're down 20%. So companies that are also employing people, FedEx, UPS, Walmart, Starbucks, a lot of unionization going on and a lot of higher wages. But those higher wages allow those consumers to pull through food, pull through consumer products, pull through those goods that are non-discretionary expenditures. And so those are coping with the higher prices of oil being pulled through to the consumer through the higher wages. The participation rate is still low, though. So where Steve said that the millennials or Gen X's need to work to pay for the retired baby boomers, they don't want to work. So the Gen X's and the millennials, their participation, overall participation in the labor force has dropped because from 63.5 to 62.5. So there are fewer people that are participating. But for them to come back into the labor market, there is some slack there, but they would need to be forced to come back into the market. I mean, I look at the way, some young people's attitudes are that I know through my, anyway. Yeah. Do we all look back and say, God, I worked hard when I was young, and the young generation don't work as hard as I did? I think every generation, my dad probably said that about me, right? I don't know. So the Fed is really going to go overboard here. They're going to take. So Steve, do you want to explain how big the Fed's balance sheet is and how that's going to work off from 9?
Yeah, so the current balance. Yeah.
See the mic?
Here I am. Yeah, so the Fed's current balance is 9 trillion. And since the beginning of the pandemic, it's increased by about 4 or 4.5 trillion. Yeah, 4.5 trillion. And they will work this off, much like they did with the stimulus following the GFC, through the expiration or maturity of the mortgage-backed securities that they purchased, and also treasuries, which, you know, if you look at the money supply in the US into money has increased by 41% in the last 4 years, which is driving inflation. But so the work off of the Fed's balance sheet is going to be through attrition, and that'll take some time.
So they bought a bunch of treasuries, they bought a bunch of corporate bonds, they just let them mature. Okay, and then as they mature, the balance sheet will drop. So it's not like they're going to sell them, but they're going to raise interest rates. So all that stimulative stuff of buying lower quality credit so that banks had cash that they could lend out and increase the money supply, that created money supply and liquidity, and that liquidity will no longer be provided. So that could be a headwind for asset values. Democrats, what's this little mark here? Democrats are going to lose seats, basically, is the view here. And that has a lot to do with the war in Europe, which the war in Europe is, I mean, I'm sure we're all getting to this point, but what I said last month, it's going to get worse before it gets better. And, you know, I'm going to say it again, it's going to get worse before it gets better. There is no easy resolution in sight here. It's not like, you know, Putin's going to say, oh, wow, these really hurting my people, you know, with these economic sanctions, let's stop. Is he going to do that? Anyone think he's going to do that? Is he more likely to drop a nuclear bomb than he is to do that, right? I just don't see a very good ending. This 275 out of 500 companies have reported, but that's 73% of market cap. So the biggest companies reported. We had a lot last night. Earnings are 83% beating, 3% in line, 16% missing. Lockdown beneficiaries did not grow from the new levels. They've actually had a pull forward and a drop off for Netflix and some others. So they do have some tough comparisons. Airlines, hotels, cruise lines, a lot of debt for airlines, cruises, hotels. And when you add debt, you add leverage and you add volatility. So again, we're not going anywhere near those sectors, even if they are sub-10s. Okay? There's just too much risk built into them now, especially Carnival and Royal Caribbean, in the debt levels that they've had to take on to see through. And you know, and I'm looking at how many people are here today, and I'm going to compare that to a cruise line. How many of you at, you know, retired people are going on cruise lines with, you know, 2,000 other people? You're not going to do it. Even if the pandemic is over, you're not going to go on a cruise line and expose yourself to a COVID outbreak, even if you've had 3 shots. It's not happening, and as evidenced by the number of people who want to attend in person here. So we were not into the cruise lines. Okay, would you talk about? Yeah, we will, Tim. We'll get to that right now. Bifurcation reconciliation is accelerating. Google overshot 15 times earnings. They don't have debt. They got 120 billion in cash. 120 billion in cash.
Yeah, net cash.
And 70 they're going to spend on a buyback. I mean, so it's overshot. Google's overshot. Financials, 3 big things: deglobalization, working off Russian exposure, but big gains in trading. So Goldman Sachs making a lot of money in trading, right? IPO markets were hot last year. They've cooled. Investment banking is cooled. So the whole argument of that Chris likes to talk about, you know, the virtuous cycle. Well, what time is it now?
Well, I can touch on that.
Can you? Yeah, why don't you explain?
The next slide. It's Goldman, I believe.
Okay, we'll touch on that. M&A is slower, and Citi is writing off some Russia-Ukraine exposure. So why don't you talk about gold?
Thanks, Joe. So before I cover the Goldman quarterly earnings. The virtual cycle is one of our macro themes that has supported our investment thesis in Goldman Sachs, but in a climate of rising equity values and cheap debt, it has created a virtual cycle for merger and acquisition activity, because the two sources of funding, raising equity or cheap debt, will beget merger and M&A activity, raising prices. You know, that these transactions usually take place at a premium, and that creates this virtuous cycle of rising equity prices and more transactional volume. And one way to invest in that thesis theme.
The rising interest rates is slowing the virtuous cycle, right? So the cost of debt has gone up, and M&A activity is changed immediately with the rise in interest rates about 3%. So you've seen an immediate change in that virtuous cycle and an inflection point there. So I would say, Chris.
I would say that M&A activity is very volatile, and the weak figures this quarter for all of the banks in their investment banking divisions were compared to a very strong quarter in the previous corresponding period. So that's a tough comparison. But rates are still relatively low. So
but Microsoft's funding the acquisition out of cash.
yes.
They don't have to go to debt markets. Right?
So that's the other. Well, yes, a tech company, especially with a good balance sheet, or still high equity price.
But a leverage buyout is just not.
But still, debt at 3%, I would argue, is very attractive. It's not as attractive as it was, but still, it's supportive, I think, of M&A activity. So one way to play that virtuous cycle theme is to invest in takeover targets, which is obviously comes with a lot more risk. But the leading investment banks tend to be pretty consistent over time, and Goldman enjoys about a 20% market share. And so that's one of the how one of the macro themes we've identified plays into this specific investment recommendation. First quarter revenue was fantastic versus the estimate, and most of the beat was driven by the fixed income, currency and commodity trading, which saw the overall trading up 4%, and that helped offset weakness in underwriting, the equity trading, and investment banking, all compared to very tough comps the year ago period. Per share earnings beat, but still shy of the $15 that we were seeing pretty consistently through the last 2 years, $15 a quarter. And that's partly a function of the rising conversation cost, which is some shareholders have been critical of. But I would point out that in 2021, I beg your pardon, in 2020, revenue was up 22%, compensation expense was up 8%. And in 2021, compensation expense rose 33%, in line with the revenue growth. So I would argue that there's a bit of catch up there, and that we're happy to pay for talent. I mean, if you look at the way Goldman managed the Archegos blow up versus some of the peers, they had an immaterial impact on their business. And you can contrast that experience, especially with what's happened at Credit Suisse.
Well, Credit Suisse is just a disaster. I mean, their stock price is what it was 20 years ago. And it's not just I call it Archegos, but we call it Archegos. It's, you know, the melon. And they're churning through management, and they can't fix things, and they're a disaster, and they're worth 20 billion, and they fall into 630 francs or something, or 650 francs, and they're horrible. They're horrible. Would you buy on that weakness?
No, I think stick with Goldman.
Okay, let me ask you another sort of.
I could tell him.
Let me ask you another question here, Chris. Okay, so if Musk is buying Twitter for 44, and he's teamed up with hedge funds, is he how is he financing that? Okay, number one, there's liquidity coming out of Tesla because he's got to sell some Tesla stock to buy some Twitter stock. He's going to pay cash for the Twitter stock, so his Twitter shareholders will receive cash. So that's a cash for Tesla transition. But how's the rest of the transaction being funded? Is it through debt markets?
Yes, I understand he's sourcing additional co-investors privately for equity as well as debt.
as well as debt.
Yeah, there's a
So-
consortium of investment banks that have committed a debt facility, a margin loan. He is, as are other managers of Tesla or office holders of Tesla. They're limited to pledging, I think, a quarter of their shareholding to margin loans. So in addition to that, he's got an unknown amount of cash and equity, and he already owns part of the business. But I understand he's seeking private debt and equity co-investors.
So when I first came to Australia, I was offered a job at Credit Suisse, and they were the premier M&A group in the world, bar none. They were way out ahead of everyone else. So it just shows over 30 years, now they're a disgrace. So, you know, things change. And there were some good people there when I was there, and they were good to me, you know, including that guy, Mike Fitzpatrick, worked there, and Peter Thomas. And that's how I ended up meeting, you know, Elders Finance Group, is because they introduced me to Elders. So it's things change, right? So will Goldman be there in another 30 years? I think they got a good system. Consumer products are passing on higher raw material costs, and the consumers are cashed up and they're able to pay for it, but we're not seeing any opportunities emerge. Those stocks stay high, and some of them 22, 23 times earnings for no growth. You look at Procter & Gamble, or you look at Heinz, or you look at Kraft, and they got the same sales or revenue that they had 10, 15 years ago. They got good margins, good, stable, predictable earnings, but they're going nowhere. You're buying them for their yields. And I just can't pay 25 times earnings for no growth, even if I am getting a 3 or 4% yield. Now, the tobacco companies, you're getting like Imperial, you're getting like an 8% yield. That's pretty attractive. If you want a yield, it's better than buying treasuries. Okay. At media and entertainment, the lockdowns really were a pull forward rather than a new paradigm, right? So that's what we're seeing right now. So it's more of a pull forward. Netflix is the poster child, and they saw a fall in their subscriber growth, and it's showing that content is king. So you got to have good content. And, you know, Paramount fell with Netflix on the news, but we still think that, the other companies in this sector, Disney, Electronic Arts, and Amazon Prime in particular. I got 2 phone calls from Amazon Prime today asking me to log in to a remote website to these scams. You know these scams, right? You know they work. They call you up and they say log into our website, and then they try and get you to open up your bank account. Anyway, so I got 2 of those calls today. Both Amazon, yeah, both from Amazon. So these stocks are getting smacked, right? Shopify, Etsy, Shopify, but Activision Blizzard, they had disappointing earnings as well. Very disappointing, but it doesn't matter. It doesn't matter they had disappointing earnings. What matters is whether Microsoft's going to complete the takeover. That's out of sequence, but do you want to go over that one?
Sure, you basically touched on it. Activision Blizzard is a merger arbitrage investment solely. I think facts of interest would be that Berkshire Hathaway on the weekend announced that they have a 9.5% stake in the company. And Warren explained it very clearly. He said, look, this is a workout. He's confident in the high probability that the deal will complete, probably earlier than anticipated. Right now it's set to complete in June of 2023, but Microsoft is fully funded and ready to complete the deal tomorrow if they had to. It just requires European and US regulatory approvals, which are somewhat uncertain, but it wouldn't surprise us if this completes in early 2023, which would deliver us a 22% return from the current price.
Has Warren lost it? I mean, he's
I don't
talking
think so.
like, what is he, 93?
It's 91.
91, and he's talking about long-term trades. This isn't a long-term trade, but he said he wouldn't buy Bitcoin for $25.
Yeah, well, you know, I mean, he's always had a strong opinion on these types of non-productive assets. He said he'd rather own farmland than real estate.
Is he a
something
reliable
productive.
opinion for you to stand on
For me to stand on.
when you recommend activism?
Oh, well, I just think that it speaks to the credibility of our thesis.
It does.
Because we came up with this before Berkshire announced they had a 10% stake in the company.
Yeah.
So, you know,
So he's endorsing us.
That's how I view it. Yeah.
But is the purchase they pre-existing, or is they have actually purchased up?
Yeah, they said in the meeting that they had 9.5, but they did not have an obligation to announce it in a filing until they get to 10. But he did announce it at the meeting.
But they already had.
They had,
They've been holding it for.
Well,
they accumulated it over the last month or two, I think.
Well, they purchased about 15 million shares prior to the announcement of the acquisition, which was,
But recent.
yeah, and then they added to the position in the first quarter. So they had a small position and they added significantly to it in the first quarter. But anyway, I mean, that just,
I think it's good to be investing alongside Warren Buffett at this stage. I agree with that, you know, but the cynicism would say, you know, is he past it?
well, I mean, he's 91 and Charlie's 98 and Warren maybe.
Charlie's 98.
Charlie's 98. But they sounded pretty good in the meeting, you know, which is incredible. He drinks 2 liters of cherry Coke every day, fully sugared. Goes to McDonald's every day.
McDonald's.
Yeah. He said that if the market's up, he'll get a hash brown with his breakfast. If it's down, he won't.
Well,
Anyway.
it's
But so just on this one, there's obviously a lot of cynicism about their ability to get regulatory approvals.
Yeah.
Is it because the Europeans would want to have a win over some of the
the
American
Europeans
tech
and the
companies?
Chinese,
Okay.
but it really is about Lena Khan. And
What
we'll-
happens if they don't get the Chinese?
I don't think
They
then they can't sell
excise
stuff in China.
They won't sell in the Chinese market. But even if the deal doesn't complete, the break fee is extraordinarily
$2
high.
billion breaks.
Yeah, it's a $2 billion cash break fee that will be paid to Activision if the deal doesn't complete for any reason.
So the downside might not be $20.
No, I mean, it was $65 before the announcement. It's essentially $78 now.
Well, $2 billion is $2 a share, just almost, right?
Yeah, it's about 3.5% market cap.
3.5. So it's okay.
So,
So it's about $2.50 a share.
yeah, give or take.
Yeah. Okay.
So there's, you know, a margin of safety there with this sizable break fee. And I think that speaks to Microsoft's confidence that the deal will complete. This is a vertical acquisition. It's not horizontal. The video game industry is very disparate. There are a lot of small startups in the space that are competing.
You know, it would be Lena Khan's first big test. And I can't see her doing it in this because the gaming industry is, and we'll refer back to the report that we wrote, Kelly, when was it? November 2020, where we talked about how fractured the gaming industry is and how low the barriers to entry.
That's reduces competition.
Exactly. Yeah, I don't need it. We don't need it. But Elizabeth Warren would say if it's more than 5 billion, it shouldn't be done, whatever the industry. Right? Is that what you said?
Yeah.
More than 5. Any M&A over 5 billion should be banned. So that's the kind of rhetoric we're dealing with from Elizabeth Warren, who ran for president and, you know, was in the running, and she got lots of her arguments from Lena Khan, who was at Yale writing her thesis on Amazon.
Yeah.
I can't see it being blocked. And I can't see Lena Khan going to Matt over this deal.
Yeah, and a lot of the weakness, I mean, might suggest there's uncertainty around it completing, but I think it also speaks to just the nature of ETFs, that when the market goes down, as a component of an ETF, it gets sold off. So the Nasdaq's down 20% year to date. A lot of, I think, the pricing of Activision is a result of just ETF selling.
I give this a 99% chance of closing and a 99% chance that you make 22% in the next 12 months.
I guess the only thought is that Microsoft acquires one of the 2 biggest gaming companies in the world, and it runs one of the 2 consoles, which account for the majority of the gaming industry.
Open platforms.
Yeah. Okay, so Xbox, so there are 3 major console makers, Sony, PlayStation, Xbox, and Nintendo. And Xbox has the lowest market share of about 16% globally. So they are behind the other competitors. But there's also, with the advent of streaming, the
proliferation of gaming platforms have just exploded. You know, you can play a game by a service called Steam or Google Play or Apple Play. Everybody has a platform, so you're not, you know, married to a console anymore.
Candy Crush is a simple little download app, right?
Yeah.
Yeah, you just, I mean, have you ever, well, I was in the subway in New York and everyone's Candy Crush. You know, that's not a console. And how easy is that to build and sell? I mean, that hit the formula. Paramount, you want to talk about Paramount briefly? They were fine, right?
Yeah, EPS beat 60 cents versus 52-cent estimate, very slight miss on a revenue basis, which really matters to, I think, the market and investors is the growth in their streaming platform, their main platform, which is now called Paramount Plus, had 20% user growth quarter over quarter. And then they have this Pluto TV, which is an ad-based service that has 68 million global active users. But this is the headline. Shares were neutral. They reported that.
Now we wanted to, let's get to Boeing. Okay, I'm going to skip the pharmaceuticals, and Bayer was coming out on the 10th. They're doing fine. So Bayer, of course, is our investment in seeds in Europe, seeds and pesticides in Europe. So that's doing well because there's bigger demand for crops as a result of Russia and Ukraine being, you know, a big wheat producer. So people need seeds and pesticides. Let's growth stock, Intuitive Surgical down, HCA higher wages, Hospital Corporation of America, Da Vinci stuff, so elective surgeries, biotech, Illumina. We considered Illumina. They do the DNA testing. Then we'll go to ancestors.com and see if you're related to whoever, right? So that stuff's becoming cheaper and cheaper, and there's more and more being done. But as the price goes down and it gets cheaper, they're eating their own revenues. Moderna, I just want to get through to Boeing. Hotels, restaurants, Starbucks was on the list. Didn't, you know, it was on our screen list because it was down 18%. There's some unionizing going on, so they're going to, you know, pay baristas. I can't say that word that Biden can't say either. What is it? Kleptocracy? Kleptocracy. What did you see that one? I can't pronounce that word either. You know? But Biden should have been able to. Okay, so but I can't say barista either. Okay, Apple down, Alphabet down 19% in these stocks, and I do want to get to semiconductors. Qualcomm and Western Digital, very good results out of both. Very, very good out of both. Western Digital up another 15% last night.
Yes.
Okay. Qualcomm, but I do want to get to Boeing, and then we'll come back to those if we can get through Boeing. Okay. So who's going to do Boeing?
I'll talk about Boeing.
Good.
Another very messy quarter with miss on revenue and profit. But one of the key metrics is free cash flow. And despite having a negative free cash flow quarter, they've maintained their guidance for the current fiscal year being a positive free cash flow year, and still have a good amount of liquidity on the balance sheet in the range of 17 billion. There were some new charges this quarter, some associated with Russia, but some also associated with the very aggressive fixed pricing that Trump negotiated for Air Force One, a couple of jets, which are taking a lot longer and incurring a lot more expense to refurbish. I think the CEO described the deal at the time as a great deal for the American public, but not so much for Boeing, who generate about 30% of their, historically, they generate about 30% of their revenue from the US government, and 70% from commercial, and they're pivoting away from the fixed pricing contracts that they've historically negotiated with the government, which come with low or negative margins.
Biden would have never done that deal.
Yes, and there's been some more delays with deliveries on some of their later jets. We recognise that this is going to be a very volatile turnaround story, but a lot of the leading indicators that we're looking at, like the resumption of commercial airspace, travel, and liquidity that Boeing enjoys, the progress towards recertification and certification of new models, and a significant backlog. We think that all supports a multi-year recovery to a normalized earnings, which we assess at being around $15 per share. So Joseph, the view this will be a
When it gets
more than
back on
double.
track and recovers, it'll double, easy, same as Paul, it'll double.
Yeah, so we're urging patience.
Western Digital.
Western Digital, two very positive events in the last week. Stocks up nearly a quarter. First was the third quarter earnings, where there was a solid beat on revenue and earnings. And what we're seeing is some easing of the supply chain and COVID-related disruptions, which were the cause of the disappointing second quarter results. And then just last night, Elliott Management, a New York-based activist hedge fund, one of the largest in the world, with about 75 billion under management, disclosed a 6% stake in the business and issued a letter, which is public, to the board, proposing that they split the flash and hard disk drive businesses, and they've even committed as part of funding a split up to another $1 billion. Their initial investment, 6%, is about $1 billion. So that was received positively as well.
Want to take it on?
Sure. So we're back to 10 stocks in the model portfolio, buying Activision Blizzard and the two supplementaries, I should say, Alibaba and Baidu. So we'll open up to any questions. I know we're right on time. So thanks for joining us today.
Thank you. Well, let's have a beer. No, let's have a.
Thanks.
Thank you. Okay. Tell you.
Yeah.
Well,
Can I ask you,
for people who are online, we do have Russian caviar here today. So we encourage you. It's on sale.
Joe, I wanted to know whether
Subject to
you
sanction.